Let's talk about all of that with Jyoti Jaipuria also joining us today on the show. Jyoti, good afternoon. What to your mind are the factors right now which are playing of the pressure setting in after a couple of good weeks and days in the market?
Ajay, see, I guess what you have to remember is that we've had like a rally which has been very, very sharp. Over the last 1 year, the market's up like 23, 24%. And if you take like a 2 year or 3 year, it's a very sharp rally we've seen. So, just in terms of statistics, Nifty has been given a positive return for the last 6 calendar years. And, like in the history of Nifty, there's never been a seventh calendar year where you got a positive return. In the Sensex, we have because Sensex has a longer history. So seven has been the maximum that you get as a positive year. So to that extent, if you just see performance-wise, probably markets need a bit of consolidation. But I think the key factors are going to be two. One is valuations, and the other is the central banks, which are probably going to worry the market over the next few months.
So 2022, what is the nature of your own portfolio, or how are you looking at which are the sectors, the underowned ones, perhaps the auto, banking, all of that? Do you think there's a case for some outperformance in that side? How's your portfolio structuring looking right now?
Yeah, so you're right, Ajay, that some of these, where is the values, it's in some of these sectors which are not done well. So for the last 18 months, we've been actually quite underweight the financial pack, but that's the space where we've been adding to our weight continuously over the last 6 to 8 weeks. The second is we've been keeping cash in our portfolio, so we have more cash levels than we've had for a long time. So just now, our average cash position is between 15 to 20% in the portfolios, which is just to take advantage of if we get a correction, we get share prices falling. The third sector, like you said, is auto, which we want to add at some point. I think there's value in auto, and we're just waiting and seeing how this whole semiconductor crisis plays out. But probably on the margin, we've been adding to auto also in our portfolio, and we probably will get more aggressive with these two sectors, both auto and financials.
Right. Jyoti, let's talk about financial a little more in detail. Private sector banks is an area of interest from your perspective, or you are also open to looking at NBFCs which have just not participated in the market?
Yeah, so Ajay, like I guess the way I split it is there are retail banks and there are corporate banks, and obviously there are private sector banks in both the retail and the corporate side. So if you see the last 10, 12 years, it's all been about retail banks, and whether it's in the NBFC space or it's been in the bank space. So I think it's the time has come for the corporate banks to do well because of two, three reasons. One is we've seen a lot of provisioning which has happened from the corporate banks. So to that extent, the need for provisioning in the future is going to come down. Second is with corporate profitability improving, you probably are going to see some of these things which have been treated as NPLs starting to come back, and they'll probably end up paying over the next 2, 3 years, which will be another good sign for the banks. Third is I think credit growth will pick up because we probably will start seeing some signs of capex spending coming through 18, 24 months down the road. So all these make probably the corporate side of lending as a very attractive space to be in. Just remember these have underperformed a lot. Generally, they are not owned much by investors, so they're underperforming, they're underowned at this stage. And so and as things improve, we think there'll be a re-rating there, there'll be a earnings pick up there, both of which will help share prices.
Jevo, ready, Ujit? Right. What are your thoughts on the mid and the small cap end of the market purely on valuations front? There are stories out there, and then there are narratives, and then there are stories which are backed by numbers. Do you see merit to nibble into broader markets once market does provide during the course of the year some corrective phase sets in, a deeper one, a meaningful one, not like the shallow correction which we recently saw? Would you be keen to look there in that area?
Yeah, so Ajay will be keen. We obviously run one of the best performing small and mid cap funds. Our small cap fund was probably number 2 for calendar 21 amongst all the 250 PMSs in the country. So we are keen on small and mid cap, and we continue to like the space. So there are three things which I always look at what stage you are in the cycle. So first is valuation. Valuation no longer is cheap relative to the large cap. So in some sense, valuation, the easy trade on valuation re-rating is over. But the two other trades are basically these small and mid caps always do well when the economy improves. And we think the economy is going to improve, earnings are going to improve. So to that extent, earnings growth in the small and mid cap is going to be sharper than the earnings growth in the large cap over the next 2 3 years. And that's one reason why you have to buy the small and mid cap and keep it, because that will give you a bigger return in your portfolio. So even though valuations no longer easy trade, valuation easy trade got played out over the course of 21, where these guys outperformed large cap by a big margin of some 30%. But there's still more room for these guys, for all the smaller cap to actually outperform the large cap. So we continue to be very positive on them. But like I said, we probably will see a correction. When the correction happens, you could see a larger correction in some of these small and mid caps. And investors should avoid some of these very frothy companies. Look for companies where there's visible earnings growth rather than get excited about stuff where there are a lot of stories roaming around.
Right. All right, Jyoti, we'll let you go with that one. Thanks so much for joining us with your thoughts on how you are approaching the markets right now.